Good afternoon, everybody. Welcome to our Advanced Option Strategies webcast. I'm Connie Hill, sitting in for Brent Morse today. You know, how many of you are trying to find like the ideal strategy? You're thinking, what is the best one? Well, it's hard to know sometimes. But would you be interested in learning a strategy where you had unlimited upside potential with also a little bit of built protection in? Okay, that's what we are going to focus on here today. It's called a back ratio spread, and we'll give you some examples how we might consider using a strategy like that. Now, I do hope you're following your favorite people, your favorite coaches on X. I'll post educational material. My handle is Connie Hill CS. We have the pleasure of having Cameron May in the chat. He's here to help maybe field some questions, although I'm going to keep an eye on the chat as well. And he does a lot of great posting as well. He's Cameron May CS. So take advantage of those little nuggets that we post throughout the day. Let's go through our disclosures and let's get on with a pretty full agenda for today. Options carry a high level of risk and are not suitable for all investors. This information that we talk about is intended for information and education. Don't consider it a recommendation. Short options can be assigned anytime up to expiration, regardless of the in-the-money amount. We're going to be using the Paper Money software application. This is what you download to your computer. It has a paper version side, which basically means paper money, but live market data, so that you can practice in any new strategy you want to practice in your paper account first. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results or success. All right, typically we want to take a look at what's going on in the markets. They were up earlier, and then I've noticed maybe we've been having a little bit of a sell-off. So we'll just kind of take a quick look at things. We'll talk about construction of advanced option strategies. And like I said, we're going to look at a few examples here today that I want to get into. That's not the right slide. What I wanted to show you is some of the strategies that we'll talk about in this session, advanced options, and it's not limited to this, but these are some of the most common ones. And we're going to be focusing on the ratio spread here today. All right, let's head over. Let's see what the markets are doing. I told you that it looked like they were starting to sell off a little bit here. Let's maybe zoom in on the SPX. You can see put in another new high, like it did yesterday, like it did the day before, okay, like it did last week. And it just keeps grinding a little bit higher and a little bit higher. So yeah, hit another new high today, but looks like it's pulling back a little bit. So right now, currently, I mean, it's pretty flat, down just 0.01%, which is pretty much flat. On the NDX, now I noticed it was going weaker a little bit sooner than the SPX was here today. It too put in another new high after having an all-time high yesterday and the day before and previously as well. So a little bit more of a pullback here, down about 0.58%. So some of the tech stocks are the ones that are starting to see a little bit of weakness in here. What do you think's going on with the volatility index, the VIX? If we're seeing the market sell off, would we expect VIX to be higher or lower? Well, we would expect the VIX to be popping up a little bit. Now, as we've had a fairly bullish market, it's mainly stayed in a low range. In fact, you can see I put on this little channel, blow it up here, where it was a downward channel where the lows kept getting lower and the highs kept getting lower. But more recently here, we're starting to see maybe the lows start going a little bit higher, maybe just inching that direction a bit. You know, if we get a spike up here at 18, 19, 20, something like that, then it's a little bit more noticeable in the market. We start to see a lot more selling off. People become a little bit more defensive, or maybe it hits in that range and they're noticing that they want to make some adjustments on some bullish positions. That can always happen. Well, let's do this. Chris says, you know, the discretionaries are weakest today, which is interesting because they have been a little bit on the stronger side, haven't they? Yeah, when I've been running my search that I run almost every morning and post results, consumer discretionary has been one of the sectors that's been stronger along with technology. But sometimes we get a little bit of rotation in there. So we'll see if our current pullback in the market fix a tiny bit higher. You can see it's not incredibly high if that kind of pushes some things around here. Now, I want to talk about this strategy of a ratio spread. How many of you currently either trade or have traded in the past a back ratio spread or a front ratio spread? If so, I'd like you to chat it in the box. I want to kind of gauge how familiar you might be with this strategy. I know Brent has taught both of those on occasion, and he does such a great job going through many of these advanced option strategies and spending an entire session on it. And we're going to spend the entire session today on this back ratio spread, but curious to see how many of you really trade it or even familiar. And there might be some of you that go, it's new to me. I haven't done anything with it. What the heck is it? You might get the idea that it's a ratio, a strategy that maybe is a little different because maybe it has a different ratio of contracts in there. Okay, Charles is a no, Greg's a no, Posh is a no. Lewis says you like the 1-1-1, buy one put, sell one put, and sell another put below. So kind of maybe a variation of the true, but that's interesting that you've experimented with that, Louise. Thanks for sharing that with that. Sean says I have done some back ratio spreads, never a front ratio spread. Well, when Brent kind of goes through the strategies, one thing you'll learn is that the front ratio spread is more designed if you're expecting a smaller move, but the back ratio spread it might be more appropriate for somebody if they're expecting a big move. Well, what's going to start in the next couple of weeks? Earnings. Do stocks move pretty good over earnings? They have a tendency to. I mean, it's not guaranteed that they will, and you can go back and look at history and see, which stocks do move quite a bit with an earnings announcement and which ones might not. Let's see what Scott says. Okay, Sharon did some a while ago. Let's see. Scott says, I'm not sure what this is called, but I have 100 shares plus one call and sold 2 higher priced calls. Okay, interesting. I'm going to say it's probably a combo spread of some sort. And that's the thing we can have some fun with here in this particular class is, okay, we know some of the basics, credit spreads, debit spreads, maybe some variations of those, doing some iron condors and some butterflies. And, how do we maybe go about putting together a trade that's not as common because we are using maybe one contract of one and 2 of another, or possibly even 3. Now, the ratio that we're going to use today, we're going to be selling one at the money option. In our bullish examples, it's going to be a call, and then we're going to be buying 2 out of the money options that creates kind of that 1-to-2 ratio. You could go 1-to-3. You could go 2-to-3. There's no fixed rules about what those numbers have to be. But the most common one for people to maybe start out with is going to be a 1-to-2, and that's what we're going to use here today. Now, let's take a look here. Let's see, Riceburg says, my learning is more with cal meaning calendars and diagonals, that you've been reviewing many of these. That's great. And I'm going to just kind of put a plug in here for trading examples in paper money. Several of you have said, I really haven't seen this strategy before. The best way to get to know a strategy, seriously, is to paper trade it, okay? It's not to sit there with your feet up, cushy, eating bonbons and sipping a Diet Coke, just kind of watching us do stuff. It's like, okay, let me practice that trade too. You can just do it in your paper money account. Those are where we learn a lot more, maybe a little bit faster as well, I would say, is if we're kind of going through a process so that we can learn from it. So right now, if you're focusing on calendars and diagonals, perfect, Ricebird. You want to continue doing that so you feel comfortable with it, out in your paper account, and then maybe slowly move and gravitate with that strategy towards your live account, starting with, really small contracts. Now, one thing about these ratio spreads is we can get into them, I'm going to say some of them, not always, but kind of at a cheaper price because we're selling an option. And the option we're buying is a little bit out of the money, which means it's less expensive. And so that can help, but it'll give us this downside protection. So first one we're going to take a look at here, and we are going to be focusing on stocks that will announce their earnings next week. All right, Levi. They're going to announce their earnings on Thursday after the market closes, I believe. Let's come out here. Yep, it's after the market closes on October 9th. So we're kind of seeing this advance. We can see, okay, yep, they're going to have earnings. What kind of a trend have they had? Well, you can see on this 6-month chart, man, it's had a fairly consistent bullish trend here, hasn't it? The blue line is my 10-period moving average. The red line is a 30-period moving average. The blue is exponential, so it's going to be a little bit more reactive. And the 30 is a simple moving average. And then I've got these lines on the chart, these yellow lines that are coming out here. And this is a script which is plotting the market maker move. Now, hopefully you're getting familiar with what the market maker move is. And essentially, it is as a stock is coming into a big event. It doesn't have to be earnings. Maybe it's a product announcement. Maybe it's an FDA expectation of maybe the results of a trial, maybe a biotech company has going on. Okay, those are like really big news events. And what they'll do is they'll take the at the money straddle, meaning, say if it's a $50 stock, $50 call, $50 put, and add the two ask prices together. And that's the expected move based for that news period, okay? And so this little script here will put it in your charts for you. Some of you may have this, some of you might not have it. And I'm going to share it with you because I think it is such a handy thing. So let me just copy on that. Remember, anytime we share scripts with you, they're not guaranteed as to accuracy or timing, but man, they sure are handy. Hopefully, this is an advanced class. Hopefully, you've been exposed to a little bit of scripts, but basically, you would just take that address that I typed out there to you, except not the words MMM on chart. That's me telling you what that script is. But you would take the formula, come over here to open, shared item, plop in the code part. Okay, so I'm just going to delete. I'm going to start with that exclamation point. The exclamation point is the first character on these scripts. And then you just hit preview. And then this is what I've named it, MMM on chart. You could give it whatever name you're comfortable with, but remember what it is so you can go find it again, okay? Because you're going to want to pull it up on your studies on the charts, right? So if I come over here to my studies, here is mine, MMM, MON chart, and it's using kind of an orangish color. So that's what those two plotted lines are. So the expected move here is in the neighborhood of about 9.49%. And so then it'll calculate, well, what would that price be? Well, up here, that's about 26.76. And if it were to drop, that one isn't showing up. Well, it's kind of hiding a little bit. It's going to be what? Not sure why my little thing is right smack over it. In any case, it looks to be maybe just a little bit higher than 22. So that's the expected move we expect. So let's go ahead. Let's say, okay, let's suppose we want to take advantage of this. Let's suppose we're thinking the stock is likely to continue to go bullish, although we all got to find out together when they announce the earnings. There's no special trick to knowing if we know exactly what they're going to say. We don't. Okay, so we'll use what the trend is. We'll look at the news, see what maybe the expectation is to get a feel for if it's something we maybe want to try speculatively to play for earnings or not. So let's set up this first one here. Notice the price of the stock right now on Levi is $24.44. So our at the money strike price is whatever's closest to the current price of the stock here. Now, because earnings is next week, we are going to use the options that give us a little bit more time that would cover next week. And actually, on the ones we're going to look at today, most of them are going to be these October 17 expiration. Okay, it's got about 14 days before they expire. So knowing 24 is our strike price that's at the money on this right now, what's nice is we actually have single dollar increments here. Sometimes we don't get that. Sometimes we get like $2.50 increments or $5 increments. Usually the price of the stock is a little bit higher, but it's fairly nice on this one that we do have single dollar increments because it can kind of help us fine tune what we might want to do. Now, if the expected move on Levi is in the neighborhood of $2.34. That's where we also see the market maker move. Can you guys see that? Hopefully you are getting familiar with that. It's kind of a funky graphic. I think it kind of looks like barbells, freestanding weights, but really it's an MM on top of a single M. Okay, that's kind of what that icon is. So 234 is the expected move up or down. So we're going to start with the at the money, which means we're going to be selling the at the money call price here. And really the closest we could go at the money, or we could go slightly out of the money. When I was looking at this earlier, I was thinking maybe we might go at the 25 strike price that's slightly out of the money, and then buy two contracts that are of the 26 price on that. So this is how we're going to set the trade up. Let's go to the ask price here on that first call. We are going to sell this, but we're going to put it as a buyback ratio. So when we do our left mouse click, we're going to say buy, and then we're going to choose back ratio. Now, the system doesn't know what we really want as our long leg. It's just going to go grab the next strike price in sequence. But this might be appropriate for us. If the stock is priced to move $2.31, what's that going to put the stock at if it actually moves that far? Right? That's going to put it at about 26, almost $27. And so if somebody wanted to, they could say, well, let's do something a little further out of the money, closer to $27. But there's not a 27 or a 28 here. It jumps all the way up to 30. So sometimes it might not fit exactly what that money market maker move is. Okay, our 3 M's. Sometimes it just doesn't align with that. So we're going to do just what's closest. Okay, which is going to be the 26 strike. And so you can see here the one we started with, the 25, our at the money call, is the one that we're selling. That's kind of our downside protection piece. But we also are along 2 calls. Now, 2 calls, do they have unlimited gain potential? Yeah, they absolutely do, right? That's kind of one of the beauties. And so kind of bringing both of these strategies together gives us a little bit of a hedge position. And is the price super expensive? Well, not on this one. Right now, it's at about 23 cents or $23 per contract. Now, I want to take this to the Analyze tab. How many of you are getting good at the Analyze tab? Go ahead and chat into me. Wiley says, does seasonality chart help or the probability cone help? Either one could be used. In this particular case, we're not going to use it because we're using different tools. And actually, let me delete that. So I've said hide positions. We're doing this ratio spread, selling the 25, buying 2 of the 26. Now, let's take a look at this chart in a little bit more depth here, okay? 23 is our net debit, but could we lose more than that on this trade at options expiration? The answer is yes, and you really want to be aware of that. See this blue turquoise line? That's our profit and loss line at options expiration. And so it dips longer, it dips down more than $23. In fact, if I go down here to where the max loss is at options expiration, the blue teal colored line, it's saying the loss would be $122. Okay, we're viewing that data in this little square that's in the bottom left-hand side. Okay, that's where we're seeing that. Looking to see, Luis, you're getting familiar with the Analyze tab. Great. Is Levi a market leader in consumables? I don't know. I haven't researched it from that aspect, but their stock has been around for a long, long time. Right now, they're having a bullish trend. So right now, some retailers are doing well. Some of them aren't doing as well. Okay, but it is a lower price stock. Okay. So if we come down here and we're like, well, a 122, we're going to be risking unlimited theoretical max gain, but there could be a loss here of 122. So we want to make sure, at least in our example trades that we're going to do, we want to position size to that maximum loss. We're not going to position size to our $23, okay, because it can be $101, $100 more worse than that. So that's why we want to position size that way. Now, for our purposes today, we're just going to do a 1 short contract, 2 long contracts, keeping a 1-to-2 ratio here. But again, you could do 2-to-4, 3-to-6. You could do 3-to-5. You could go 3-to-4, 2-to-3, right? You can play around with these variables here, but we're just going to kind of look at it simplistically. Now, Jayton says, is the probability range 68.27 by default? Can we change it to see other? Yeah, you absolutely can. It does default up here in the probability range to that 1 standard deviation, but if you pull down on this arrow, you can see you could set it to 2 standard deviations or 3 standard deviations. But it's interesting because what it's showing right now, this room here is basically what's the probability that it would be at a max loss, which is the $23. Okay. And then the other side of the area of the 68.2% range on the standard deviation looks like it's at about $26.95, so almost $27. Okay, so that's the range that the expected move is expected to go in. But in this case, we are using also the straddle, and we're using the money market move to identify how far we think it could go. Now, if this thing disappoints, and right now it's at $24, and what if it doesn't get as big of a move as we expected? I mean, we're hoping it goes so that it's above here, our break even, but our break even at options expiration's got to be clear out there. That's looking like about $27. Market maker move is about that. But for us, we would love for it to go higher than that. So if this is a stock that you maybe don't think can do that, or that maybe it's only going to budge a little bit to 26, where our max theoretical loss is at options expiration, then you might not want to do this trade. You might go, why would I do that if I don't think it has the potential to really move? Does that make sense? Things you don't forget, says Isha Hasha. I don't know what those things are that you don't forget, but hopefully this is one of them. All right, we're going to put in this trade, and then let's talk about managing the trade. Earnings is going to come out Monday or Thursday night, so we would just kind of sit on this trade. Now, because we're long 2 options here, could it be that implied volatility expands and the price of the option expands because of that? That is a possibility, right? So maybe in the trade, maybe it gets to a point, maybe this net debit creeps up a little bit, and you're kind of using this pinky purple line, which is based on today's date or whatever date you have plugged in here, right? Because we could go to Monday, Tuesday, Wednesday. We can plug those dates in because earnings will be Friday. In any case, if over the next week we get a lot of implied volatility, and say you're sitting at a 30% gain or 40% gain, maybe even a 25% gain, you might go, you know what? I think I'll just take the profit. I think I'll just get myself out of the trade because that implied volatility is expanding. That's one of the virtues of this trade, is that because we have those long options, yeah, we definitely could. All right, let's go ahead. We're going to say confirm and send. And remember, our max theoretical loss could be substantial, $122. So we're not going to do a lot of contracts. We're just practicing doing a practice trade with the strategy. If you could risk, say, $1,000 per trade, you might consider doing more contracts, but see what the max loss is. If you do hit 122, say if it was $1,000, might be kind of in the neighborhood there of about what, maybe 4 contracts max that you could possibly do. Might even end up being 3. Let's go ahead and hit confirm and send. And let's see if we get filled. Sometimes I like to maybe come back here and open up the lock and see if it's changed, and it has. Okay, so the price is going up. It's going to cost us a little bit more than it would have if I put it in right away. It may dance around a little bit. Looks like that's the midpoint. It's still a fairly low price. Okay, so let's go ahead and hit confirm and send. Let's send it in based on that. All right, looks like we got filled at 28 cents. Okay, that's better than 33 cents. We'll take 28 cents or $28 there. All right. Monday, or well, Monday, Tuesday, Wednesday, as we're watching this, and even Thursday, if you're still in the trade, we talked about maybe when people might consider getting out before even the news is out. Then we're going to watch it and we're going to see where does the stock go. And if it goes the direction we want, would like to see it go, if it goes up, that could be a positive thing for us. Let's get that back in here. I'm going to put in simulations because I wanted to see this back in there now that it's a trade. It doesn't expire until the 17th. So that could leave us a little bit of time as well to maybe run into the first part of the next week. Some people might do this type of a trade right before earnings, or they might decide to do the trade a little bit more in advance so that the stock has room to run up. Now, we don't have a ton of earnings yet next week. There are a few stocks we're going to look at them. But once we get to, say, the second week in October, the banks are going to start coming out. We're going to have a lot of stocks starting to announce their earnings. Okay, but the idea here is maybe it could continue to run for us. All right, maybe it moves a little bit, but they had good news. You think it could continue to move some more. And so we would let this trade advance. And you might decide that maybe if it gets a significant dollar figure that you're happy with that profit. We spent $23 and now you're getting back, say, double that. Maybe you're getting back $46 or $100, whatever it might be. You might decide that as well and say, you know, if I get that profit, I'm going to be a happy camper and get out. Looks like for $100 on this one, the option would need to move by October 6th up in the neighborhood of about, let's go back to $100. Looks like maybe that's about $27.40 or so as far as the price of the stock goes. Okay, could also inflate because of implied volatility. Let's go to check out another bullish example here. We're going to spend a little bit of time tweaking this particular one. A stock that's going to announce their earnings, AEHR, is a stock that is going to announce their earnings on Monday night. Okay, so here we see little icons letting us know that it's going to be after the market closes. So we would have through trading on Monday. Same rules. If the implied volatility really expands and we're happy with the profit that it gives us because of that, great. You could get out of early and not play over earnings, right? That's always you don't always have to play it as long as you were considering, right? You can always say, hey, I'm happy with that profit. Let's go ahead and maybe even take, if you're doing multiple contracts, you could maybe scale out of part of them. All right. Now, do we have to wait for a particular entry sign here? We really are not looking for a particular entry sign because we're really doing it as an earnings move. However, we want to be in line with what the dominant trend is. Okay, so on this stock, 30-day moving average is headed up. The 10-day exponential moving average is headed up. So it's definitely a bullish position. So we might consider using calls again for this back ratio. Now on this one, let's go ahead. And on this, we're going to use the October 17 options here as well. And I'm looking at this one. We've got $2.50 increments. Then we have our 25 strike. Our 30 is technically our at the money. Okay, so we don't have single contracts here. It goes from 25 straight to 30. All right. So which one's our at the money option? Well, it happens to be that 30, right? That is our at the money. It's moved a little bit here, but let's go ahead. Let's do a back ratio spread. Let's sell one contract of 30, and we're going to sell one contract of the 30 and buy 2 of the 35s, which is further out of the money. Okay, so right mouse click, buy, back ratio spread, get to start with the strike price we started at by selling it. Okay, and then you have the that's kind of the hedge, and then we have 2 long contracts. Now the net debit here is about 60 cents. Is that super expensive? Probably not for a lot of traders, but remember the max loss is going to be max loss is going to be greater than what that, or I should say can be greater than that net debit. Usually when you put up the analyze risk profile, you'll see that that's the case. So let's go here to analyze trade. And let's change our date here. Let's move this back to today. Well, actually, that's next Friday. To today, which is the 3rd. Here we go. And let's see what's going on here. Maybe I didn't hit this quite right, analyze trade. You know, my analyze trade was being a little bit funky yesterday or the day before, so let's take a look at it. Okay, options expiration day here on this one is going to be the 17th again, so we'll keep it at that 18th date in the calendar. We can do a set slices to a break even, and it's not liking that. Oh, let's do this. I need to put it back to hide positions and just show simulations. All right. Yeah, there it is. It's been hiding a couple times as I kept putting it over. So I'll remind you, pay attention to what this is set to, hide positions. And now we're just looking at the simulated trade. So it's going to cost us about $60 to do this. What's the max theoretical loss? Okay, we're going to go on options expiration. It's going to be down here. That's looking to be, ooh, look at that. 558, 559, significantly bigger. And you might say, man, I don't know if I like that reward risk ratio. And maybe you don't. Okay. And you might say, I don't like that idea of risking 559 for the potential to make, you know, maybe at this point, something along the lines of about what? That's saying 202 or 293, given this date, today's date, or the subsequent dates. Because this one will announce on Monday afternoon, let's go ahead and change our date here to the 7th, which is going to be the day after earnings. Okay, this is when the full market will be engaged. Okay, so our lines shift a little bit here. Let's set our slices to the break even here. See if that changed anything. Looks like it didn't. So there's an 89% probability that the price of the stock is going to be anywhere near $40.62 or less. Okay, on this one, with that max loss being pretty hefty. Now, let's go back to the options here for just a minute. On this particular trade, we could play with it a little bit if you wanted to. We could say, well, let's sell something more in the money and buy kind of at the money, but it kind of skews things a little bit in a way that you might not desire. But you can always play with these strike prices, okay? On this, I wanted to see what the straddle or the market maker move was. So the market maker move looks like it's almost $6. This is $5.91. I'm going to round it for purposes of our discussion to $6. All right, so we see, okay, it could go pretty wide. It could drop down to 25 and some change. If it were to drop to, oops, I wanted to analyze here. What if it does drop to 25 and change? Well, that would be down here on our max loss area of about $60. Okay. Now, stocks don't always move what the market maker price is in. I mean, if our world were like that, that might make trading so much easier if they just automatically did that, but they don't have to, right? It's just telling us how much is priced into that. And so on the top side of this is about 37.45. What if it were to go to 37.45? Let me put my mouse in that area. Here's 37, about in this range. And the gain on that would be about 1 on that day after options expiration. Applied volatility will come crushing out. So we actually might want to adjust it for that, right? We could come up here and see, okay, how much implied volatility is in there. Maybe we expect it to back off. I don't know, what would we estimate that to be? Let's collapse the October options. So we can see 151 in here, and then by the time the Novembers come around, it's down to about 114 and 110. So there could be a significant drop on this, right? We could maybe even say a 30 percentage point change in implied volatility. And if implied volatility were to do that, minus 31% on the day after the announcement of earnings, the 7th of October, and then that just changed things a little bit here as well. That, if the implied volatility did drop, puts us in a neighborhood of maybe max theoretical loss about 555-ish, okay? But it's going to vary on what happens with implied volatility. All right, so we can say practice these, right? Now, you might look at this and go, I don't know if this is that appealing to me, but there might be some scenarios that it might be appealing. We don't have time to look at one, but I'm just going to show you a chart here real quick. Another stock that's going to be announcing on, let's see what day are these guys, October 6th as well, is Constellation Brands. It's actually a bearish looking stock. So we would sell the at the money put and buy 2 maybe a little bit out of the money puts to create that ratio spread. Sell 1, buy 2. And in this scenario, the market maker move isn't really showing yet here. I would expect for it to show up as we get closer to the earnings date, okay? But right now it's not showing for much at all. But you could do the same type of thing here, where we say, I'll go ahead and, actually I shouldn't have closed that. Let's see here. I deleted it. I shouldn't have deleted it. I was going to send it on its way. I'll redo it after we're finished here and we'll follow up on it in our class next week. On this one, on Constellation, we do have some weeklies. So if somebody wanted to do the October 10s, possibly could here, right? Because they would still be in focus. Let's see here. Options expiration would be on, I say the 6th? I think these guys are the 6th, yeah. So this would only have like 1 more day to trade, which might be a little bit not enough time to really make the move you might want. If it has maybe some bad news and you think maybe it can drop a little bit more, you might be more interested in having a little bit more time on it. So you might come out here and do the October 17s. And what we were looking at here is selling because it's at 142. We would sell the 142 put because that's our at the money and buy either a 141 or a 142 or any other strike price here. And I'm just going to kind of set it up here. And let's just say buyback ratio spread. So it sells the 1. We have our 2 here. The net debit on this, you're like $4. Well, what if we put it to maybe what the market maker move was? The straddle on this at the 142 is basically $5.10, $5.40. Typically, that is what's priced into the straddle price as far as what market makers think the move could be. That's about $10, you guys. And so if you go $10 further out, you know, maybe we pick a 132 strike or a 134, something even a little further out. You'd have to play around with this a little bit. I'm just going to pick 134. Sometimes it might give you a credit. Sometimes it might lower that debit. But the trade-off here, we go back to the analyzed trade, and let's get rid of this one. Just have 132, 134. We're still going to have a point at which our theoretical net loss, or max loss, I should say, at options expiration, is pretty significant. And on this trade, what is it? It's looking like about 672-ish, 679. All right, even though initially we're bringing in a credit. So you want to experiment with that. If this is a threshold, you're like, I'm just not comfortable there, don't do it, right? Don't go out that far out of the money. Maybe choose something a little bit closer, maybe 140, 141, 139, something like that on your long leg. All right. I'm going to send this one on its way, probably with the one. Let's send it on its way with this one. We're going to hit confirm and send, and we're just going to see how this plays out once their earnings comes out. So hopefully we'll get filled here pretty quickly. Now, I hope you're following us on our Trader Talks channel. It makes it so much easier for you to find our content if you do that. I'm going to go back here. And what I wanted to show you is maybe where you could see that this strategy has been discussed before. I know I've discussed it in some classes. We could just do a search here, and I would say ratio spreads, and hit enter, and we could see, well, gee, what classes have been taught about it. And the one that came up for me first here was the one that Brent did probably most recently. It looks like this was in March of this year. He did the basics of a front ratio spread, and the week before that, he did on back ratio spreads. So if you're like, I kind of been interested in this little idea, maybe go out, watch some of one of those previous classes where Brent's taught it or somebody else. And then I'm going to suggest do the paper trades so that you can learn from it. It's hard to really learn from it. The one bad thing that could happen here is maybe the stock doesn't move a whole lot. We really would like to see it move a lot. But if it doesn't, that could be one of the pitfalls and one of the risks of this particular strategy. Well, my time is up. I appreciate you being here today. Again, if you're interested, paper trade this strategy. We'll have a lot of opportunity, especially as we get into next week. Well, I should say the week of the 13th of October, when we're starting to see a lot of earnings starting to come out. Be a great time for you to paper trade that strategy. Now, I don't see a survey today, and I think as I looked at the chat, it looked like Cameron was able to catch all the questions here, and if you're kind of getting your feet with basic option strategies, hit Cameron's class, Getting Started with Options, where he reviews a lot of those basic strategies that you might first start out with, and then this becomes kind of a variation of it. All right, everybody. Next, Mike Fairborn is going to be up with Market Movers. All right, so take a little break, grab a drink. We'll see you back here at the top of the hour. Don't forget to subscribe. Don't forget to follow us. If this was helpful to you today, go ahead and hit the thumbs up button. That helps other people find the content as well. And we'll see you back here right at the top of the hour. Have a good weekend as well. Bye-bye.